This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So, having gone through and looked at the framework, so all the principles that underlie the preparation of the accounting standards, it's important now that before we actually go through and look at the detailed accounting standards, we understand how the financial statements are prepared. So, what we have first of all to look at is IAS 1. And IAS 1 quite simply goes through and looks at the preparation of our financial statements. First of all, what it goes through and does is it tells us what financial statements we should prepare to make up a full set of financial statements. And what you've got there, you're familiar with all of them already. We need to go through there and look at your statement of financial position, so the assets, liabilities, and equity. We also have there, is it your statement of profit or loss and your other comprehensive income. So remember, profit or loss essentially is everything that has been realized. Other comprehensive income is looking at things that have yet to be realized. And the big thing that you've seen in there in previous studies at your certificate level is going through there and looking at the gains on revaluation. We've also got there your statement of change in equity. So very literal, it looks at how your equity balances, share capital, share premium, retained earnings, revaluation surplus move from one year to the next. Okay. You've also got there is it your statement of cash flows. So again, instead of looking at things from an accruals basis and based upon prudence, like we've seen in the statement of profit or loss, in the statement of financial position and changes in equity, we look here very much upon things that are factual, aren't we, with regards to cash inflows and cash outflows. Again, we will go through, we've seen it before, we will repeat how to go through and prepare a statement of cash flows because it is still examinable here at the F1 level. Bits that you see examined in ever so slight detail is that for IS1 to encompass a full set of accounts or a full set of financial statements, you also need your notes to the accounts. So remember, the notes, if you like, give you the detail. They also go through there and give you the specific accounting policies that you have followed in preparation of the financial statements. And also as well, you need to make sure they're going back to the framework and looking at one of the enhancing qualitative characteristics. One of those was comparability, wasn't it? Comparability year on year and comparability from entity to entity. So in order to go through and have comparability year on year, you need to make sure that you have comparatives for the numbers that you have prepared this year, so you can look at what you have last year. Okay, it helps the user of the accounts understand the position, the performance, the change in equity, the cash flows. So if you like, the changes in position, remember, of that entity. Okay. If you're interested, by all means, do an internet search, find a company that you're familiar with. You'll be able to go through there and find the financial statements on the internet. And you can go through there and as we chat our way through the syllabus and look at all the various different accounting standards, you can go through there, can't you, and tie it in to the financial statements that you have chosen. Okay, as we go through, we'll try and use a variety of different companies to have a look at how the accounting standards are pulled together. Okay. Again, key bit that you've got is going back to the framework. We want to ensure that we give a fair presentation of the position, of the performance, and of the changes in financial position, which is shown by your statement of cash flows. And to do that, we should go through there and comply with IFRSs, which makes sense, doesn't it? If you're complying with the rules, those rules have been derived from the framework. Then if you are complying with the rules, then you are essentially complying with the framework, which wants you to give a fair presentation of the entity. Okay. If we don't comply with IFRSs, then it can be judged that maybe we are not presenting fairly the results. But yeah, we would have to go through there and maybe apply the rules of the framework if we're not complying with the IFRSs, and we would need to categorically state why we are doing that within our financial statement. But that's a very, very, very rare occurrence. For now, at F1, as long as you are applying the rules and the standards, you will be giving a fair presentation of the results. What we're going to go through and do now is just briefly summarize the financial statement. So position, performance through profit or loss, and also your statement of change in equity. We'll leave the cash flows until the following chapter. So what you've got, statement of financial position, again, remember, it's always there as at a point in time, isn't it? Again, you should be pretty familiar with the layout and how it appears. How would it get examined in an objective test question? Well, if we go and have a look at the mock exam that is being given to us by the Institute, then what you see there is a couple of the questions give you a trial balance. So it lists out all of the balances that you have extracted from your T accounts in preparation of the TB. And the requirements ask you to go through there and calculate your non-current assets, or calculate your current assets, or calculate your non-current or your current liabilities, i.e. it's expecting you to group together particular balances to demonstrate that you know where they go within the statement of financial position to therefore then get the correct total amount. Okay, so it would work quite well as an objective test question. Okay, I don't think there's anything too much that I need to go through and add. Obviously, we have the assets at the top, the equity and liabilities at the bottom. And when we look at the assets and the liabilities, we split it non-current and current, don't we? Okay. I think one bit that I would like to go through and add with regards to the notes and to ensure that you are happy with potentially answering various questions is to go through there and look at the definition of what makes something current. Okay, because when we were there in the certificate level, we essentially said that if it is going to be sold, if it is going to be paid within 12 months, then that will therefore make it current, which is partially correct. Okay, there's just some additional aspects that we need to consider if we are thinking about whether it is a current asset or a current liability. So one of the first things that we have is that current asset or liability. So if it is an asset, it will be realized. If it is a liability, it will be settled in the normal course of the entity's operating cycle. Sounds quite fancy. So I'll give you a moment to go through there and copy what's just above my shoulder. But it's there, it's realized if it's an asset. So you are going to collect the cash, or if it is settled. So if you were paying the cash in the normal course of the business's operating cycle. So one of the key ones that you've got there will be your inventory. Because yes, we expect inventory to be sold in less than 12 months, don't we? So it does tie back to what we had within the certificate level paper, doesn't it? But just think about maybe the inventory that you sell isn't going to be sold within a year. Let's just say maybe you're a construction company and you're constructing an asset to be sold in the future. Or maybe there you are in the furniture business and you make wooden furniture, and it's very bespoke wooden furniture. So once the wood has been chopped down and you've bought that wood, you have to allow the wood to dry out. You have to allow it maybe to mature before you chop it down. So that inventory isn't going to be sold within 12 months. It will take a lot longer than 12 months for the inventory to dry out, to mature. So it's longer than 12 months, but it will still be categorized as current because that inventory is going to be realized, so sold in our normal operating cycle, isn't it? That's what we do as our business. That's how our business operates. Yeah, the construction industry has a long operating cycle. And if you like, a furniture manufacturer of bespoke furniture has a long operating cycle. It may be more than a year, but it doesn't matter. It will still be classified as current. Okay. The other situation that you have as well is that you have a financial asset, or an asset or liability, I should say, that is held for trading purposes. Okay. So things that you are looking at there may be a little bit too high level, but derivatives, or maybe coming back to our level, if you like, traded investments. So investments that you intend to sell in the near future instead of holding for a longer period of time. Okay, so if you're holding it for trading purposes, so a traded investment or a derivative, then that will be current. Okay, then what you also have as well, going back to our certificate level, if that asset is realized or if the liability is settled within 12 months. So that's looking at, say, your receivables, or your payables. If you have a receivable or a payable that is due in more than 12 months, then it will therefore be shown as non-current. But if that receivable or payable has amounts that are due within less than 12 months and more than 12 months, then you would split it between current and non-current. Okay, so that's a key aspect there, particularly if you have any long-term loans within the business. You would need to show what you're going to pay within the next 12 months and then what you are going to pay after 12 months. Okay, just bits and pieces. I think maybe it's going a little bit too far at these early days, but just to be aware, what you have there is just some specific further definitions to do with your current assets and also your current liabilities. By definition, your cash and cash equivalents, they have to be categorized there with regards to a current asset, okay, because they're the most liquid asset, aren't they? So they could be converted into, you get the cash back from the bank straight away, couldn't we? Or if your cash equivalents, your government bonds, your government gilts, you could get that from the governments very quickly. It's very liquid, isn't it? Okay. And then with regards to the liabilities, if you have a liability whereby you have no right to defer the settlement, then that will be also classified as a current liability. Okay, maybe there are particular specific types of liabilities whereby you have the option maybe not to pay within 12 months, but defer that payment until a later date. If that's the case, then it would be classified as non-current. Okay, but if you have no right to defer the settlement, then it has to be classified as current. So just little bits and pieces just to go through there and focus upon with regards to current and non-current. Other than that, I don't think there's anything too much there to go through and focus upon. Again, remember your equity shares that you show on the statement of financial position are your issued share capital, and then everything else that you have there, share premium, irredeemable prefs, revaluation surplus, retained earnings, they are all your reserves, aren't we? Or aren't they? Sorry. And we show their movement within the statement of changes in equity. Okay. Again, going back there to irredeemable and redeemable. Again, it's accounting for the substance, isn't it? The economic reality. Because when we go through there and go back to the framework, remember, we had those fundamental qualitative characteristics, didn't we? Of which one of them was going through there and looking at your fair presentation. The other one was relevance, wasn't it? And something was relevant if it was material. Excellent, well done. And the other one was sorry, not fair presentation, faithful representation, wasn't it? That was it. And things are faithfully represented if we go through there and account for things based on substance and the economic reality. Now here, the legal form of preference share capital is that legally it is a share, isn't it? Okay. But the economic reality depends upon the terms and conditions attached. So if it is irredeemable, there is no obligation to pay cash, is there? You know, it will never, ever, ever be paid back. So therefore, legally it's a share, and in substance, it also looks like a share. Okay, so therefore we treat it as equity. Whereby your redeemable preference share capital, there is an obligation to pay cash, isn't there? Okay, it has to be paid back in the future. So when we're looking at the substance there, the economic reality is it looks like debt, doesn't it? Okay, I've taken money in as a business and I am obliged to pay it back at some point in the future. It also meets the definition of a liability, an obligation to pay cash. So therefore it is treated as a liability. And I really like talking about the irredeemable, redeemable aspects there, just to tie it back into the framework that we looked at in the previous chapter. Okay. Other than that, all the balances that you then see in the categories of assets and liabilities are all required to be disclosed on the face of the statement of financial position. Okay, so have we got there property, plant and equipment, investment property, intangibles, inventory, receivables, cash, cash equivalents, issued share capital and reserves all need to be disclosed. Your separate liabilities for current and non-current with regards to payables, overdrafts, tax payables. But I think you understand. Okay, everything that's shown up there needs to be disclosed. Okay. The only reason why I mentioned that is because when we go through there and look at your statement of profit or loss and other comprehensive income, what you've got there is your standard method that we see of presenting your statement of profit or loss. It's the recommended one. Just note this method is looking at presenting your expenses by function. So by function, we're talking there about cost of sales, distribution, and admin. The other option that you have is potentially to go through there and look at it by nature. Okay. So when you look at it by nature, instead of grouping all of the costs based upon the function that they perform within the business, you will put them in by nature. So you will have your revenue, and then you would have staff expenses. Okay, so wages and salaries. You would have depreciation as a line item, amortization. You would have impairments. So it's just a little bit of a different way of presenting your financial statements. You very rarely see it. I think, if memory serves me right, and I need to go back and check upon this because it's been a while since I've done it, but I think if you have a look at EasyJet's financial statements and look at EasyJet's statement of profit or loss, you will go through there and find that EasyJet prepare their statement of profit or loss by nature. Okay, so it actually lists out the separate expenses line by line by line. Okay, there we go. Other bits and pieces, again, nothing too exciting happening within terms of profit or loss. Just a point to note, the specific line items that must be, if you like, disclosed are revenue, finance costs. So you don't need to go through there and disclose cost of sales, admin, distribution. What has to be disclosed is revenue. What has to be disclosed is finance costs. What has to be disclosed is your income tax. And what has to be disclosed there is your profit for the year. Okay. The rest of the items do not have to be disclosed, but in terms of aiding the users of the accounts, it's common practice to disclose all of the expenses, whether that's by function as we have here, or whether it's by nature as you see in some businesses. Okay. Again, moving on, just to go through there and look at your other comprehensive income. The only other comprehensive income that we've seen at this moment in time is your gain on revaluation, because things that go in other comprehensive income, your OCI, are, if you like, unrealized, aren't they? So we've revalued our property upwards. We haven't yet sold it, so we haven't yet realized the gain on sale. So therefore it's stored up there, isn't it, within your other comprehensive income. Okay. Again, what you then do is you take your profit for the year, you add that to your other comprehensive income in total, and those two figures there will combine to give you then your total comprehensive income. Okay, excellent. What we then go through and do, don't we, is we then go through and we start to look at our statement of changes in equity. So here you've got everything to do with your equity. You look at the movement on that equity and the statement of changes in equity, and that movement on the statement of changes in equity comes about from the profits that you make for the year and the other comprehensive income that you have within the year. So what you've got there over the page, your statement of change in equity, like your statement of profit or loss and other comprehensive income, is there for the year ended. You've got your equity shares and then all of your reserves, share premium, revaluation, retained earnings. You've got your closing figures at the bottom, which should be the figures that you have on the statement of financial position. Here, what you can see, first of all, there's an issue of share capital. So we must have credited share capital, so credited the equity shares and credited share premium. As you can see that both of those have moved. You've then got your dividends, so make sure that you put the dividends there within brackets to show that it is a distribution of the earnings and is therefore reducing the retained earnings. The total comprehensive income for the year you can see there is split, isn't it, between the amount that you have on your evaluation and the amount that is there for your retained earnings. So here, what goes into your retained earnings is your profit for the year. And here, your evaluation surplus is the gain on revaluation, isn't it? Okay. You've then got the transfer to retained earnings. We did touch upon that at certificate level very briefly. You've possibly forgotten it, which is why we then reintroduce it later on when we begin to look at property, plant and equipment. Okay, so what we're allowed to go through and do is that gain that we have on revaluation, every year we can take a little bit of it and put it back into retained earnings to make it therefore into more of a distributable reserve. Okay, because as it is unrealized at this present time, it is non-distributable, and we are allowed to adjust that figure to make parts of it distributable in retained earnings every single year. But talking about distributable, non-distributable reserves is just a little bit too far at this point in time, but I think it is perfectly valid to have it there as a discussion. Okay, excellent. You do see a little bit of the statement of change in equity examined as part of groups, so it's important that you understand and make sure you know what you've got there before you then go through and attempt it within a group account situation. Okay, other than that, there wasn't really too much there within that chapter. What I would do is I would have a go at the questions within the revision kit. If there's anything that you get wrong, make sure that you learn from the mistakes and make notes upon it. Okay, because I think that by practicing the questions as you go through the sessions really does help you to understand the knowledge that you need in order to get 70% on these objective test questions.